certainly think that the engineers who used to run the New Zealand electricity system were both wiser and smarter than the business people and economists who've been responsible for most of the reforms. And so from my point of view, I would be quite happy if we had more engineers back in charge, not only of running the companies, but in charge of actually rethinking how we have structured the whole system. I wanted to do two slides to start with, which are not about electricity, but are about the reform period. The first one is on the growth of the New Zealand economy. This is using the familiar old metric of gross domestic product. And I've marked in blue there the period during which Roger Douglas, Ruth Richardson and their cohorts undertook a major set of reforms of the New Zealand economy in the name of improving efficiency and sparking a more rapid growth. And what you can see there, the red line, is the actual path of per capita GDP in United States dollars on a log scale, which is taken from the United Nations National Accounts database. And you can see that New Zealand's economy has had three major downturns in the last half century or so. One of them is the oil shock in the mid-1970s. One of them is the global financial crisis over there in 2008 to 2010. And the biggest of the three is the neoliberal reforms of the 1980s, which stopped the economy in its tracks for a decade and left us with a growth rate which is identical to the long-term growth rate shown by the dotted line before the reforms. That's just a very quick way of checking that we did not get from the Norgenomics reforms any of the promised increase in the growth rate of the economy, but we did get a huge setback. The second chart that I wanted to put up is the inequality indicator, the distribution of income within the New Zealand economy. Again, I've marked the Douglas and Richardson period with green lines. The blue line is the Gini coefficient, which is the normal way of measuring inequality of income in the economy. And the dotted red line is the ratio of the bottom 90% to the top 10%. It's a similar sort of measure to what extent has the top 10% pulled away from the rest of us. And what you can see is there was just one period when the inequality of income in New Zealand went really massively pear-shaped, and it's there. It's during the neoliberal reforms. After that, we've consolidated a much, much more unequal economy than we had before we went into those reforms. And we've done this without getting any payoff to economic growth overall. So remembering the big promise of the reforms, the idea was that if we corporatized, reorganized and privatized, the result would be gains for consumers because firstly, commercial profit-driven management would raise efficiency and cut costs. Secondly, competition or appropriate regulation would force efficiency and productivity gains to be passed through to prices. And thirdly, consumers would enjoy better services and lower prices, while profits would still be able to rise because there would be such a gain in efficiency that there would be a win-win for everybody to share in. So that more or less was the promise we started with. I've just run into trouble. There we go. The outcome, 1986 to 2018, we've now had 4 decades really of the reform process. Productivity in the electricity sector is down 30% over the 3 decades. So we've lost 1/3 of the efficiency in the sector. Prices for residential consumers have doubled. The prices for industry have gone up a couple of percent. Prices for commercial users have dropped. But gross profits across the industry are up 80%. Now, if you increase profits 80% while cutting productivity by 30%, that's quite an achievement. And the only way that you can do that is that somebody is carrying the cost, and the people who are carrying the cost in the New Zealand case are residential consumers. So my interpretation of that is that the profits have come not from efficiency gains, but from price gouging under cover of entrenched market power. And the countervailing power of big business has protected the industrial and commercial uses. And I think it's especially significant that it's the commercial sector, which includes big finance and a whole lot of other related, essentially rentier parts of the economy, if you like, which have had undue influence on policy. So the bottom line is the big promises were hollow, and we're now left with something which may need cleaning up. Whether it needs cleaning up is up for the politicians, and I think it's very striking that no party going into this election has a policy on the electricity sector as yet. We can hope that something may emerge. So going from here, what I want to do, first off, some quick history, then some macro numbers, then some economics, where can the excess profits arise, and a bit of modelling of how profits arise and are created in the generation sector, and then some policy options at the end. Okay, so the quick history. Before 1984, we had an essential service collectively provided as a public service model. Since then, we've had electricity treated as a commodity like any other supplied by corporates. Before 1984, we had electricity priced as cheaply as possible to households. The goal was well-being. It was treated essentially as part of the welfare state social contract. Since 1984, it's priced to recover the full cost of the marginal generator, plus a monopoly price for each line's network, plus a fat margin for the dominant retailers. Before 1984, it was run by civil engineers who were committed to optimal planned outcomes. Since 1984, it's run by corporate managers and financial engineers, maximising profit and shareholder value. And before 1984, we were running an integrated monopoly, but a monopoly that had non-profit objectives. Since then, we've got multiple players in a very complicated institutional landscape, allegedly competitive and allegedly regulated markets, but the supposedly competitive markets are not really competitive, and the regulated markets are not really regulated. And so the result is we end up with the worst of many worlds. You're probably familiar with the time sequence of the reforms, so I'll just leave that slide for a second and then pass on to the substantive stuff. So first off, looking at the big macro numbers, here's the efficiency measures. This is labour productivity in the New Zealand economy as measured by the Statistics New Zealand and the national accounts. What you're looking at is how much measured economic output do we get from the inputs that we put into each sector of the economy. In this case, we're looking at labour. So this is how productive is the labour force. And you can see that the most productive sectors of the economy in the last 20 years, since 2000, has been information, media and telecommunications up here. It's got a percentage, it's gained 120, it's 120% gain in productivity since 2000. The New Zealand average is the green bar in the middle. That's a gain of about 25 to 30% over the 20 years. That's not actually much of it, that's not good. As you'll know, people keep on complaining about the poor productivity performance of this economy, and it's not stellar. But if you want to know what keeps the average from being a little bit higher, well, one thing that keeps the average from being higher is that we're carrying a couple of real deadweight burden sectors that are really dragging productivity back in the average figures. And right at the bottom of my list here is electricity and gas, which has over a 40% drop in labour productivity over those 20 years. Here's multi-factor productivity. This is you take combination of labour inputs and capital inputs into the sector and ask what has happened in 20 years. Here's the New Zealand average there. And down here are the two real lagging sectors, electricity and gas and mining. Now, mining, you can understand why it's not performed particularly well. As engineers will know, the oil and gas sector has been running into diminishing returns. You know, the Maui gas field gave us an enormous boost in mining productivity. We're into much less productive oil and gas. The gold mining sector is running into diminishing returns at the margin, is the ability to dig huge holes in the ground and pull lots of gold out is easing off. So I'm not too surprised about mining. There's a natural resource constraint that's binding on the mining sector. Electricity is entirely a self-inflicted wound. This is a sector where we put, put renewable resources and replaceable labour and capital in, and we're getting a massive fall in the productivity of those inputs. So just to have a look at the time path of this, this is going back to 1978 because the productivity statistics run from 1978 right up to 2019. And these are the indices that Statistics New Zealand produces showing what has happened to the various bits of those productivity stories. The red line, just to look at the time bits, what I've done is divided this between the starting period when the New Zealand Electricity Division ran the electricity sector, the restructuring period when we had Electricity Corporation and all sorts of other restructuring getting underway. Then there is the 1990s leading up to the Bradford reforms with the corporatisation of lines companies. And then with the Bradford reforms locked in, the period since 2000, you have the completely restructured electricity sector getting on with its activities under the new set of regulatory and institutional arrangements. So the red line is labour, the labour inputs, the blue line is capital inputs, the orange is the average, or no, the total inputs, that is capital and labour combined, and the black line is output from the sector. So yes, output has been growing, sure enough. It has slowed down in recent years because demand has been a bit flat. The crucial things to see are firstly that labour inputs went down very sharply in the first decade and a half of reform, and that was because the corporate manager's idea of how to make a sector more efficient was to lay off a lot of labour. So there was huge job losses, and most of those job losses were what I call productive workers. They were linesmen, they were electrical engineers, they were hands-on, technically capable, skilled labour. Then you can see that once the Bradford reforms were consolidated, labour inputs have gone up again, but the people being hired there are not what I would call productive workers on the whole. Most of them are in the administrative, financial engineering, public relations, advertising, playing regulatory games, legal consultants, and so on. So that the sector has moved from employing people who actually handled electrical stuff into being a sector which has an increasing number of people who are basically pushing paper around and making impressive statements. Capital, you can see, has been going up all the way through. These guys love investing money into capital goods, so they've poured vast amounts into increasing the capital stock without getting any corresponding increase in the output from the sector. They've built fancy headquarter buildings, and they've put money into a whole lot of stuff, but the payoff has not been that stellar. So just following the productivity then, those were the inputs and outputs. Here are the actual productivity indices over time. You can see that all the gains during the first decade or so were simply because they laid off workers. It was a huge labour shedding exercise. And once they got rid of as many workers as they could, in fact more workers than they should have, labour productivity just embarked on a steady downward track as the sector was loaded up with less and less productive workers, with higher and higher salaries, by the way. Capital productivity, you can see, has been on a downward track right through, with just a little pickup here in the mid-90s. It's not easy to explain. And multi-factor productivity, you can see, picked up early on because of the labour shedding, and then just embarked on a 25-year steady downward track. There's no break in that trend to be seen. And I would be mentally projecting that forward. I think we'll see multi-factor productivity continue to decline. This again is the productivity story looked at from a slightly different perspective. What I've done here is taken three sectors of the economy. The green bars are the economy as a whole. The black bars are the goods producing industries as a whole. That is manufacturing, utility services, mining, and so on. It's not the sectors that aren't in the service part of the economy. The reason for that is that services are very, very hard to measure productivity. And then the red one is electricity, gas, water, and waste services. This is a much more aggregated sector than I had before. The stuff I showed you before was just for electricity and gas, and the gas part of that was only reticulation. It's just running the pipelines. It's not actually producing or refining the gas itself. So electricity dominates. So as you can see, back in the days before we restructured, this is the growth of annual productivity, and you can see that electricity and gas and water were the leading growth sectors of the New Zealand economy in the early 1980s. If you were looking for a sector to restructure and completely knock around with neoliberal reforms, this should have been the last one you touched. As they got underway with corporatisation and privatisation, you can see that the growth rate of productivity fell. And once we had the Bradford reforms in place, you can see that productivity growth has gotten massively worse. Okay, so you're looking there at the 40 years during which we effectively destroyed productivity in that sector. Bottom line, we've loaded the sector up with labour and capital that are engaged in increasingly unproductive activity. The pursuit of profit and all the complicated competition games and financial engineering we've gone through means more and more labour and capital are allocated to high-paid sales, marketing, financial management, and administrative stuff. Corporatisation and privatisation is a gigantic exercise in rent-seeking waste. So that's what I have to say about productivity. It's not particularly happy story, so let's take a look at prices. First, the average price, then the specific prices by sector of the economy. This is the real electricity price average across all consumers since 1974. You can see that back in the days of Muldoon and Birch, you may remember back in the 70s, those of you who were around then, there was a big argument about the electricity price, and in the wake of the oil crisis, the electricity price was hiked quite sharply. That was to try to get money in to pay for things like Rangipo and the Clyde and other projects that the government was keen on. From there on out, the price came down and then stabilised during the first decade of the reforms. That reflects the fact that there was in fact a political commitment to try to get something coming out that looked like some savings for consumers, but you can see there's no real saving there across. The price just goes horizontal, and then the Bradford reforms kick in and the price takes off pretty much inexorably over the last 2 decades. If you look at who was bearing that price, the black line is the one from the previous slide. The residential price is the line with black squares on it. The industrial price is across the bottom here, includes TY Point, by the way, and the commercial price is the triangle, the line with the triangles on it. The thing that strikes most people in New Zealand who live in houses that have electricity is that they face inexorably rising prices up until the last 4 or 5 years. And the last 4 or 5 years, basically because demand has stopped growing, the price has finally stabilised, but it's stabilised at a level double what it was for residential consumers back at the beginning of the reforms. So that's where restructuring starts. There's the corporatisation, the breakup of EC&Z, Lines Energy Split and all that stuff. And here we are with the Jen-Taylor cartel, price gouging, lines, monopolies and fake regulation over the last 20 years. Comparing us with other countries in the OECD, this is an index series. 1986 is set to 100, so you're just looking since 1986 at the comparative performance of all the OECD countries compared to, well, not all of them, the bunch that I've got there, compared to New Zealand. And this is for household electricity prices, and you can see that New Zealand is way out there in terms of driving up the price. Countries that have seen the residential price come down, that is, which have had a focus on consumer well-being rather than on corporate profit, are down here, Japan and Korea. Surprisingly, in some ways, the United States, but they've been much more serious about regulation and genuine changes in the States than we have. And France is down there too. Now, that red line there is Australia. You can see that Australia, just in the last decade or so, has been catching up rapidly with New Zealand. That's because Australia got around to implementing very similar reforms to ours and constructing a very similar market to ours, especially in the period after 2000. And lo and behold, they've got exactly the same breakout of the price. From index numbers, you move on to comparing the actual level of prices. So we take the the residential price of electricity in United States dollars per megawatt hour at purchasing power parity. That's a whole set of complicated things that you do to make sure that country by country you're comparing like with like. What's the sacrifice to a consumer of buying a kilowatt hour of electricity in terms of the bundle of things that they can buy in a globalized international marketplace? Now, you'll know that industry spokespeople talk about we having the 11th lowest residential prices as the sort of promotional bump that you hear from the industry these days. Well, this is the long-term trend. And New Zealand's the red line. The OECD average price is the black line, and all the individual countries are those coloured lines. And what you can see here is that back in the 1980s, back at 1980, New Zealand was the third cheapest electricity for consumers in the world. Only Canada and Norway had lower prices than we did. Moving to being the 11th cheapest, we have gone above the OECD average right across those 4 decades. You can see that Canada and Norway are still way down there. We're up here. So this efficiency enhancing set of reforms has translated into internationally very poor relative performance on delivering a price to household consumers. Then just taking one of the sectors, the lines companies, this is where we've been regulating, so to speak. And remember that the promise was if we put commercial managers in, they will get the costs down, they will cut costs and make it more efficient in production, and they'll pass that through to the prices that consumers pay. So what I've done here is taken the price per kilowatt hour, the blue line, and the operating costs per kilowatt hour, the orange line. This is Vector and Wellington Electricity. I've combined those because for quite a while, for about a decade, Vector owned Wellington Electricity. So if you want to do a 20 or 30 year comparison, you can't untangle Wellington and Vector from until 2008. Since 2008, they're operating separately. What you can see here is at the beginning of the reforms, they were not making a lot of profit. It was basically a public service back in 1991. This was the Auckland Electric Power Board was running the show, and in Wellington, the Municipal Electricity Division and the Hutt Electric Power Board. The corporate management came in here. They very quickly cut their prices by laying off a lot of workers and consolidating their administration, and they very quickly and immediately raised their prices massively while they revalued the assets up. And what you can see here is that the profit margin went through the roof within 2 or 3 years of the corporatisation. This is the Auckland Central meltdown. I don't know if probably many of you will remember that, when Vector's supply to Central Auckland collapsed and they incurred massive costs to get it running again. But after that, we're back to the basic story. This is Powerco, which operates across much of the Lower North Island. Again, starting off, and I've consolidated here all the electric power boards that later became Powerco. Here's the electric power board era, costs there, prices there. Here's the corporatisation of 1994. Costs go like that as they strip out workers and expenses. Prices go like that as they immediately hike their charges. And from there on out for 30 years, you've got a big profit margin sustained right through. Here's Orion, that's the supplier to Christchurch, owned by the Christchurch City Council. Same pattern. One of the things you'll notice about council-owned lines companies, though, is that the council-owned ones are conspicuously among the most massively price hiking. So Orion wasted no time at all in really getting its price straight up even though they were a bit slower to get their costs down. Here's the earthquake, is that gap around 2013. You can see that you can't get decent data for Christchurch in the year of the earthquake. But coming out of the earthquake, it's consolidated back at the same profit margin. And then all the rest, this is all the little trust-owned guys around the country. And you can see that it's less dramatic with the trust guys. They didn't hike their prices as severely, and they cut their costs so heavily. They got some savings out, but basically it's less dramatic for those ones. But you can see they haven't managed to sustain their cost reductions, and they have sustained profit margins a great deal larger than they had at the start. Now, this is the regulated sector that the Commerce Commission oversees under Part 4 of the Commerce Act. And as you can see, I've had for many decades now complaints about the failure of the regulator to do anything about profits in this sector. There's hundreds of millions of dollars going through here that doesn't need to go through if we'd simply priced it on historic cost. What's happened to consumer to residential prices? Now, this is a chart that the Electricity Price Review produced a couple of years ago, trying to explain why, in real terms, household prices have gone up. You can see they've got that doubling of price from about 15 or 16 to 2018 cents to about 30 cents a kilowatt hour. And these are allegedly the breakdown across generation, transmission, distribution, and GST on the top. GST, we all know about the fact that GST has been going up. That's just part of life. But it's interesting the way that this is stuff produced by Trustpower, and they claim that the biggest hike in residential prices is because of the distribution companies. That's the guys I just showed you, raising their profit margins and raising lines charges. And according to Trustpower, there's hardly anything attributable to increased generation pricing. Now, if you believe this, I think you're going to believe anything. And of course, what Trustpower has done is massively understated the degree to which retail prices have gone up over that period. You see, these yellow bars are generation and retail and metering. And what has actually happened in those 20 years is that retail margins have massively increased. But Trustpower, in its statistical work, has gone back and reconstructed a hypothetical retailer back in 1990 and massively understated the share of the residential price that's attributable to lines charges. Now, if you've ever worked on the old electricity statistics, you'll know that they consolidated the financial numbers for the electric power boards back in those days, and the electric power boards were doing retail and distribution at the same time, and a bit of generating. And to unpackage that, you have to attribute part of the price to retail and part of the price to distribution. And what Trustpower has done here is massively understated the share that they've attributed to distribution and overstated the share to retail, and produced a piece of work which went through to the minister, and the minister clearly believed it, and the propagandists for the generators never ceased to offer you this sort of these set of numbers. But the fact of the matter is that those 1990 breakdown numbers are, in my view, completely worthless. That's just the breakdown across residential, commercial and industrial prices, again done by Trustpower. But these are reasonably okay because they're for 2018 when we do understand how the breakdown works. Finally, come to profits. Well, here's profits. This is the national accounts figures for electricity, gas and water. The green line is the compensation of employees, that is how much of the value added in the sector goes to labour. You can see the massive labour shedding of the first couple of decades, and then the increasing compensation of employees as we've got high-paid CEOs and advertising guys and financial engineers crowding into the glossy offices of Meridian and Mercury and Contact and all the rest of them. But you can see gross operating surplus, that's the profit component is where the real action has been. And you can see that if we go back to 1986, where the restructuring started, up to there, the operating surplus was pretty stable. And then kaboom, once we've corporatized, operating surplus roars away. So profits have increased massively in those last 30 years. All right, now that's the first part of what I have to say. I don't know whether you've got any hands raised at this point, Brent. Otherwise, I'll move on to talking about market power.
No hands raised, but there were a couple of questions on the chat.
Okay, what are they? Hang on, I'll click my chat. No, I can't do that. With my shared screen, I can't get the chat up. You can do.
There was one question around, it was one of your earlier slides about that showed productivity with gas, water and waste included.
Yep.
And they were just curious about what proportion was electricity.
About 70 to 80% of the sector there. And then you go to the electricity, then you go back to this one, which is electricity and gas. I actually had Statistics New Zealand rerun the numbers for me so that I could get rid of water and waste services out of the figures to make sure that I wasn't looking at something that was artificial. And I found that the results for electricity and gas alone are pretty much the same as the results for electricity, gas and water. Electricity dominates. We're about 85% of the electricity and gas sector is electricity. It's the electricity sector that's you're basically looking at there.
And another quick one, do you have any thoughts or observations about who the main shareholders are who are raking in all the profits?
Oh, well, it varies. You see, and the lines companies, Vector is still partly consumer trust and partly owned by a big bunch of people who bought shares on the share market, including some big cornerstone operators. Orion is still totally at Christchurch City Council. Several of the smaller ones have local council ownership or local trust ownership, where trusts were installed to try to save the furniture after Richard Preble's and John Luxton's Electricity Companies Act was forced through. And Powerco, of course, is a publicly listed company with a lot of private shareholders. In generation, there are the big five: Trustpower, Contact is totally just floated off to private investors. There are the three mixed ownership companies where the state still has 51% and private investors have 49%. That's Genesis, Mercury, and Meridian. So it's a mixed bag. It's important, though, to emphasise that both three of the big generators and Transpower, the grid operator, are in state ownership, which means the government, which means you and me, the taxpayer, are big-time shareholders in this.
That's all the chat questions I've got there.
Well, let me talk about market power for a bit. Where's market power a problem? Now, this is a sort of supply chain diagram for the electricity sector. On the left, you have central generation, where the large hydrothermal and geothermal and wind farms are. Then the electricity that comes out of the central generators goes through the clearing manager. That's the little operator buried within Transpower, which does the scheduling scheduling stations to run during the half hour. Then the electricity goes onto the transmission grid, and most of it goes through to retailers, but some of it goes sideways directly into big industry who take their supply directly off the grid. Then there's the retail sector, where retailers buy wholesale electricity from the wholesale market and then push it on across the distributors' networks to reach final customers. And the retailers then bill the final customers to cover the costs of buying wholesale, getting a retail margin, and paying the networks to carry the electricity out. And this is the demand side of the market, residential, commercial and industrial. And then over to the right-hand side is the off-grid supply, the distributed generation, which includes rooftop solar and micro hydro and so on, sources of supply that feed directly to the demand side of the market, often using the networks of the distributors, but not going through the formal sale process necessarily. It's not quite as simple as this because, of course, rooftop solar tends to be sold to retailers and then sold by them back to the demand side. So I've oversimplified by drawing my little arrows there. But in terms of the economic structure, that's more or less what you're looking at. Now, I look at that, remembering that in the old days, generation and transmission and the clearing idea were all consolidated in the New Zealand Electricity Division, all run as an integrated single public interest monopoly. Then all the distribution and retail operations were undertaken by the electric supply authorities, the power boards and the municipal electricity divisions, who handle all of that in a consolidated sort of local monopoly package. And so what the reformers have done is broken the market into these components. And in the process, the reforms have opened up a whole lot of different problems. And I'm just about to show you an array of the things that I worry about. I'm only going to actually talk about one or two of them, but they're all here. Over here in the central generation, there are Ricardian rents, which I'll explain in a moment, and carbon rents and market manipulation rents. In other words, people with market power over there have a variety of ways of screwing money out of final consumers. Down here, the transmission grid is a natural monopoly, so it can collect natural monopoly rents to the extent that it's not prevented from doing so by some regulatory authority. Retail are vertical integration rents that come from the ability of retailers and central generators to merge. So after in 1999-2000, after Nax Bradford forced the lines companies to be separated from all the local generation and retail operations, all the retail was taken over by the central generators to form these vertically integrated gentailers, and there are enormous market power gains from that vertical integration, and that's enabled retail margins to go up massively, and it's that massive increase in retail margins under the vertical integration process that Trustpower has concealed in that set of charts that I showed you earlier on. Then here there are natural monopoly rents again on the local distribution networks, which are theoretically regulated now by the Commerce Act, but by the Commerce Commission, but for the first decade of corporatisation, we just left unregulated. Then here on the demand side of the market, the retailers have a total amount of money that they have to recover to pay the wholesale electricity, the cost of transmission, and the cost of distribution, and that they have a choice how to allocate it across residential, commercial, and industrial. And from the point of view of a retailer, the way to get your money most easily is to go after the people who can resist least, which means residentials. The most dispersed and powerless customers with the lowest elasticity of demand are residentials. You can't just turn your electricity off without suffering massively. So a thing called Ramsey pricing, which is originally a theory of efficient taxation, says if you're going to choose which of those groups of consumers you really put the hammer on, the answer is residential. And that's why residential prices have gone through the roof while commercial and industrial prices haven't. And if you want to know how industrial prices get held down, you just watch Tiwai Points owners any day of the week prancing around on the media. But behind the scenes, the major electricity users group wields a huge amount of muscle in preventing the prices to industrial from going up too high. If you go to electricity authority events or in fact industry events in general, you'll usually find the guys from the major electricity users group will be hanging out there and participating in the discussions, and they certainly have plenty of technical modelling capacity. you'll see nobody from residential consumers. And then over here, the off-grid supply thing. This is where market power works the other way. In all of those mainline supply things, you're looking at market power being exercised to raise prices. So price gouging, stage after stage, is the story of market power. But over here, off-grid supply is a real threat to the established big players. And so what you see out here is that market power is exercised through predatory pricing and captured regulators that are obstructing the rollout of rooftop solar, micro hydro, small wind farms, and so on. So over here, the story of market power is the story of ruthless attempts to block the development of distributed generation, which would take market share away from the big central guys. So that's a pretty depressing picture, and it's a huge research agenda, by the way. I mean, I've written book chapters and articles and submissions and stuff in all of these spaces over the years, and every one you look at, there's just a massive amount of work to do on the way that market power is distorting market outcomes. So I thought I'd talk about the wholesale market tonight. I mean, I'll spare you my thoughts about the regulation of lines companies today. I'm happy to talk about it in the question and answers if you like. This is an economist supply-demand diagram, and most engineers, I think, can handle this pretty well. Price is up the vertical axis, volume is along the horizontal, the supply curve is the red line sloping up, the demand curve is the purple line sloping down, and the economist's market equilibrium is where the two lines intersect. So at that price, PE, the quantity people want to buy is exactly equal to the quantity that the suppliers are willing to produce, and you have market equilibrium. This is a first-year economics construction. Now, when the price is PE and the quantity is QE, the total revenue, and this is where the rubber hits the road, the money that goes from the consumers to the producers, is that blue rectangle. It's the price times the quantity gives you the amount of money that this market is going to be putting into the pockets of the suppliers. Now, you'll notice that the supply curve cuts through that rectangle. And so you can break the rectangle down to two categories. The white bit down here below the supply curve is the operating costs. If you think of all the generating stations stood in a row from the really cheap ones through to the really expensive ones, so Huntly's over here and Manapuri's over here, some of them have very low operating costs, others have high operating costs. If you integrate across under the supply curve, that is, if you add together the operating costs of each of the generators and putting them in a row, you get the area of that trapezoid there. That's the money that has to be spent to run the show. And then above that is the surplus. That's the money that isn't needed to actually run the show, and that comes in as the operating surplus, which can potentially be used, for example, to invest in new capital assets, but it can also be paid out as dividends to the happy owners of the supply. All right, so this is a very standard diagram. We give this to all our first year students. And now think about what happens in a market like the New Zealand electricity market. Suppose Tiwai Point comes along, an aluminium smelter, and they say, look, you've got a whole lot of low-cost supply down here at the bottom end of your supply curve. Why don't you give us a really nice price for that? We will give you a little bit of surplus on that, but basically we will walk away with a big chunk of cheap electricity, which will make our profits better. And so what happens is that a deal is struck, the producer surplus loses a chunk, which is the amount of revenue that is not collected from the Tiwai Point smelter in order to raise its profitability, and that's at the expense of the supplier's profitability. But you'll notice that the rest of the surplus stays exactly the same. All right. Now let's get a more realistic picture of that market. The reality in New Zealand is that the supply curve looks more like this. If you've had a look at the offers, offers being put into the the market, half hour by half hour, published by the Electricity Authority, you'll find that they look a bit more like this. There's all the hydro and geothermal operators who have very low bids because they have very low operating costs. So it's just water going through turbines, steam going through turbines. The actual costs involved in producing or not producing electricity are minimal. And then out here on the right-hand end of the supply curve are the thermals, the fossil fuel plants, the combined cycle gas, the Huntley coal burning, who have a higher supply price. And the way we run our market is that we set the price out here where the high-priced suppliers and the demand curve intersect. But you can see that far from being a nice straight upward sloping supply curve, what we have is a radically kinked one in New Zealand. Again, here's Tiwai Point on the left-hand end, pulling out a big chunk of cheap electricity. So now, with that supply curve, think about how the revenue is broken down. Again, the price is here at PMC, that's the marginal cost price, set over here where the marginal suppliers meet the demand in the market. The quantity is QE, that's the equilibrium quantity, and the amount of revenue that's coming in is broken down between three places where the money goes. The low cost producers recover their costs, that's area A. The high cost producers cover their costs of operating, that's B. And then the market rent, the amount of profit that falls into the laps of the low cost producers, is area C. And so the total cost of supplying the quantity is A, the low cost producer's cost, and the high cost producer's cost. So those are all the costs of producing the electricity. The revenue is A plus B plus C. Area C is pure rent. It's collected by the owners of the low cost plant, which was built long ago, much of it. It just sits there. Capital costs have been sunk, so the surplus money coming in is just falling. It's just a windfall gain from the skies. So now you ask yourself, what's the true cost of electricity in New Zealand? And there are two answers to that. One answer says the true cost is what actually is required to run the generators. That's A plus B. And another answer says, oh, the true cost is everything encompassed by the marginal cost price. In other words, we set the price out there at the margin, and all the revenue that brings in is the true cost of electricity. Now, A plus B plus C is the New Zealand Treasury's theory of the true cost of electricity. The New Zealand Treasury since 1983 or 84 has argued that the true cost of electricity is measured by the marginal cost. A plus B is the average cost price, which is what the New Zealand Electricity Division used to charge before we corporatised. All right. And so what you've got is, if you charge the marginal cost price, you have less happy consumers, and if you charge charge just the average cost price, you have very happy consumers. You can, in your minds, draw a straight line across here that averages out the total cost of getting the electricity to the market. You can see that you would have bigger demand because you would have made it more available more cheaply, but consumers would be much happier and suppliers would be getting much less profit. This is just how markets work. So those big profits here rely entirely on the fact that there's high cost suppliers at the margin of the market. So let's think about things that could hit this market. Suppose you take the Tiwai Point smelter out. Now, if you take the Tiwai Point smelter out, the demand for electricity shifts left by the amount of the smelter's consumption. And with the supply curve we've got here, you can pull the demand right back off that high cost margin and have a radical collapse in the price down to the low cost supply price. In other words, potentially withdrawing the Tiwai Point smelter can make a huge impact on the wholesale price. And lots of people look at this and think, gee, wouldn't it be wonderful? But I'm afraid we've not structured the New Zealand market to produce this result, because this is the result you would have in a competitive market, and we don't have a competitive market. Now, here's another possibility. Suppose we bring a lot of rooftop solar in. we add a lot of supply which has a very low operating cost. Yes, it has a high capital cost, but once it's installed, it's very cheap to operate. So wind and solar, like geothermal and hydro, are renewable sources of supply, and they have a low operating cost comparable to geothermal and hydro already. So you push the supply curve to the right by the amount of additional supply from these renewables. Lo and behold, you collapse the price again. Here's the demand curve is still the same, but the supply curve has moved right. Bang, down comes the price. All right, so there are two things that Contact, Meridian, Trustpower, Genesis, and Mercury are terrified of. One is the removal of TY point, and the other is the arrival of rooftop solar and small wind farms and so on. So their core strategy that you will see playing out day by day in the marketplace is keep TY point open as long as possible at any cost, which is why they're currently offering them about between 30 and 60 million bucks a year to stay in business. There's desperate pleas coming in from Meridian and Contact and the other guys to keep TY point open. And at the same time, they do everything they can to block the installation of rooftop solar, small wind farms and so on. The big guys are simply squatting on wind farm sites all over the country that they've got consented, but they're not building the wind farms. It prevents anybody else getting in there to build more wind farms. So there's a combined strategy of keeping TY point and maintaining Huntly on the margin of the market and stopping rooftop solar from penetrating the market. Now, that's just the simple bit of it. Now I want to add some bits of complexity. Let's go back to the basic model. It's the supply and the demand curves. Let's add the emissions trading scheme to this. The emissions trading scheme puts a carbon tax on the fossil fuel suppliers. In other words, it pushes up the price you have to pay to Huntly and to the gas-fired plants to supply. In that process, you push the price up, cut the demand back, and of course, drop a huge chunk of rent into the laps of all the hydro and geothermal guys. And so you can imagine Meridian, which doesn't run any thermal plant, is absolutely wrapped by the emissions trading scheme. It's hundreds of millions of dollars basically drops into the laps of the guys who own the cheap hydro stations. And the higher the price, the carbon price goes, the bigger the rent drop into the laps of these guys. And of course, you can see the emissions trading scheme is going to push up the price of electricity to big industry as well as to you and me. And guess what? As soon as they invented the emissions trading scheme back in 2008, the government rushed on its knees to big industry to say, how much do you want us to pay you to compensate you for this rise in your electricity price? And big industry gave them a hugely inflated number, and the government handed out free emissions credits to all the guys in forestry and aluminium smelting and steel mills and whatnot, the usual suspects in New Zealand who capture most policy processes. And so there's an enormous chunk of the emissions trading scheme involves handing out free subsidies effectively to cover the allegedly higher electricity prices to be paid by TY Point and Carter Holt Harvey and this and that and the other, the New Zealand Steel Mill, the Marsden Point Refinery, whatever. So the way we run the carbon tax system in New Zealand is contributing to recarbonising the New Zealand economy. We're paying these windfall rents to the hydro and geothermal guys, massive amount of money dropping into them, and the higher the price of carbon goes, the bigger the profits will be for all the hydro generators. But meantime, the higher the price of electricity will be for you and me. And so our incentive to get out of fossil fuels and into electricity for our cars and so on is reduced every time the carbon price goes up. This is nuts. And anybody wants to see me saying it's nuts, I've got a submission to the Select Committee last January when they were looking at the emissions trading scheme, which is on my website. If you want to go and find something written on asbestos paper to stop combustion, I was furious about the way that the emissions trading scheme was not fixed when we had the chance. Then let's take another way that the market gets more complicated. Market manipulation. This is pretty well proved by now. Frank Wolak did a big study 10 years ago on this, and Steve Paletti at Auckland University has recently done one on the last 10 years. So we've got plenty of modelling work done to show that out there at the margin, if the fossil fuel guys put in a bid price that's above their true cost of supply, they can get a higher price out of the marketplace just by manipulating. And if the hydro guys play the game by withdrawing hydro offers at the right time, they can contribute to pushing the price up. And so what we've had in New Zealand is whenever there's a shortage in the market, and a shortage of water or a spike in demand, we get a massive spike in price due to the withdrawal of supply that drives the price of wholesale power right up. And we're talking billions of dollars of excess profits that are pulled in just by standard monopoly behaviour of pulling price back out of the market. If you're interested in the history of electricity to see how this price gets this process is transparent, the crisis in California back in 2000 is worth going back to look at. Back in 2000, they had a deregulated electricity market in California, and Enron, which was then a really big company playing this game, got into the electricity trading business in California and got into the game of calling up the generators to ask them to shut down so that there'd be a shortage, so the price would go high and Enron could make millions of dollars, by clipping the ticket on the high price spikes. And there was a huge controversy about this. There's lots of books and articles written about Enron as a market manipulator in California. Enron then went bust and there was a huge scandal, but it was a very effective exercise of this market manipulation power. So we've got it in New Zealand as well. That's another wrinkle now. So there's the rents from manipulation that goes to the inframarginal generators. And the marginals pick up a little bit of marginal manipulation rent as well. Of course, the generators who are really happy here are the guys who have a bit of both, like contact energy. Anyway, now, so let's sum up where all these rents go. First off, that big chunk of hydro rent is Ricardian rent. It is the profit that results just because you own a hydro dam on a river. The dam was built 80 years ago. It's not going away. It costs you nothing to have it there. Whether it's going or not makes no difference to your costs. But boy, if you run the water through the turbines rather than down the spillway, you can participate in this wholesale market and you can pick up that yellow chunk of profit. So that's a big chunk of the profits in the industry. Secondly, there is carbon rents. I showed you carbon rents. The emissions trading scheme pushes up the price at the margin and so produces this big chunk of extra profits for the hydro generators. Then there's market manipulation, withdrawing supply to drive the price up, and there's that chunk of rent goes on top. And so here you have what I call the excess profits of the industry. Some of that profit needs to be spent on investment. Let's face it, they need a surplus. The question you have to have in your mind is whether that amount of money that they're pulling out of the market is equal to the amount of money that they have to spend to keep expanding capacity in the system. And that's a really interesting calculation, which I invite any of you to try on the back of an envelope sometime. Now, let's go back to policy proposals. Back in 1992, four of us, myself, Stephen Gale, Ian Dempster and Simon Terry, wrote a little book called Hydro New Zealand, in which we did what I've just been showing you. We did a model of the market. We had the supply curve, which is the solid black line for the New Zealand system as it was as at 1990. We had a dotted line guessing at the short run marginal cost curve across that portfolio of assets. And we suggested a two-part progressive tariff. We said, let's have a contract in which 20,000 gigawatt hours a year of electricity is purchased by a single buyer at 2 cents a kilowatt hour and simply passed through to consumers. That keeps people's prices low. And if you want to play marginal cost games, as the Treasury wanted to do, yeah, you can have a higher price on the marginal block of electricity. And we thought that was about 800 million bucks there. Convert that to 2018, it's about 1.4 billion bucks that we could have saved consumers if we'd put in place the Hydro New Zealand contract that we proposed back then. Where are we now, you might ask? Well, I'm sitting here, a retired academic, doing nothing much. Ian Dempster works for the gas industry company. Stephen Gale works for the Commerce Commission. He's one of the Commerce Commissioners. And Simon Terry, like me, sits on the fringes, agitating occasionally. All right, so just summarising, if the smelter closes, the price would drop sharply. And you can see that in Meridian's share price. This is Meridian's share price through the year, starting from August last year, and running up until all of a sudden Tiwai Point announced that they were going to close. Boom. And the share market knows what Tiwai Point implies, and it shows up in all the share prices of the generators. So you can again take the back of an envelope and calculate the share price drop, work out how much capital value they think they're going to lose if Tiwai Point closes and there's a competitive outcome. They actually know in their heart of hearts that they can prevent a competitive outcome. One of the reasons why they won't get a competitive outcome is this. This is the transmission grid in the South Island. And you can see that Manapuri over here does not connect directly into the purple line, which is the HVDC link up to the North Island. You can't just put Manapuri onto the HVDC link and send the power north. You've got to take it all the way down to Bluff first and then up through these various Transpower lines, and these lines just don't have the capacity at the moment to handle Manapuri power. And the other constraint, which people haven't talked so much about, is the fact that when we built Manapuri, we only put 7 generators in rather than 14. It's quite unlike Maraetai, for example, which can be a load matching station, so that you can switch Maraetai 2 on and off to give frequency control, but you can't do that with Manapuri. It's got to run base load because it has a limited amount of generation capacity. Rooftop solar, again, I showed you this. You put rooftop solar in, it crashes the price potentially. And if you add a Tiwai Point closure, it's even worse from the point of view of profits. Rightio. Now, having quickly run through the consequences of market power, what happens to stop you having a well-focused policy response to these sort of problems you have in the industry? Here are 2 problems. First off, the structure is entrenched by legislation, and we've got all of these things which I call the iron cage of neoliberal laws: Commerce Act, SOE Act, Energy Companies Act, Electricity Industry Reform Act, the Commerce Amendment Act, the Electricity Act. All of those provide you with a framework which makes it very difficult for government to do anything dramatic to stop this stuff. And the other thing is the government is on the take as well. So if you go to Grant Robertson and say, would you like to smash electricity industry profits for the benefit of your consumers? In other words, would you like to take a well-being approach to this? The answer will be, have a nice day, but no. Because the government's fiscal surplus depends on the flow of profits and taxes it's getting out of this industry. And this is just the cash receipts that the Crown gets from the gentailers and from Transpower. You can see that there's a big slab of dividends, the blue lines, that the Crown pulls out from its ownership stake. And you can see that going to the mixed ownership model in 2013, 2014 made almost no impact on the Crown's dividends, because the companies have been so massively profitable since they were moved into even more predatory ownership than before, that the Crown has in fact managed to keep its dividend take up while actually handing another big slab of dividends out to people who've bought shares in those companies. Then there are the taxes. You can see that the massively rising profitability of these companies in the last decade has translated to a huge increase in the taxes that they're paying to the Crown. So the Crown is now getting on for $2 billion a year from just the generation and transmission part of this market. You can also see that privatisation, the red lines, has brought in massive amounts of dough to the Treasury. This was Contact Energy back in 1996. This was the mixed ownership model, selling off the 3 state-owned generators back in 2013 and 14, and then concealed back here as well. You can see that in 1999 there is a huge dividend collected by the Crown, and that is from the full selling from the process of restructuring the generators into the 3 new SOEs, which bought the assets off ECNZ, and from the privatisation of Contact, which had only been sort of restructured and half moved to private ownership in '96. It's fully moved to private ownership here, and that all showed up as a huge dividend that the Crown got from ECNZ, which got all the sale proceeds from flicking the generating portfolios off. So the Crown is getting a lot of dough here. Summary, what have I said to you? The multi-factor productivity is down, residential prices are up, operating surplus is up, redistribution of wealth from residential consumers to the electricity asset owners and the commercial users has been massive. So the increasing inequality and poverty in New Zealand is attributable in no small measure to the electricity sector reforms. And the move that residential consumers have had is from no choice in a low price market to lots of so-called choice in a high price market. And that essentially is a summary of what neoliberalism has been about. And then I thought, well, I'll put some policy things up, I'll give you a quick preview of them, and then we can have a bit of discussion. First off, you could take electricity over again, scrap the profit-driven model, install reserve capacity on the margin in some way, instantly get rid of the flow through from the carbon price to renewable price, rebalance the prices so household prices come back, in other words, stop screwing households, make net metering mandatory so independent suppliers can get into the market, break up the gentailers by divesting their retail, abolish the lines energy split locally so you can have integrated local companies, abolish the limits on lines operators' investment in generation, amend the emissions trading scheme, overhaul the Commerce Commissions, amend Part 4 of the Commerce Act, give the what Labor and the Greens tried, open the way for local electricity pooling, and that's just starting. So, you know, it's not that we're lacking options. What we're lacking is political will to do anything about the problem that we have. So that's me, and I've gone an hour and a quarter. So you may be so tired of hearing me that you want to stop now, but I'm happy to take questions.
Well, thanks a lot, Geoff. I think after listening to all that, I know exactly what to do. Give up and give up and.
Yeah, that's what I sometimes feel like doing. Yep.
So now, do we have any questions? Brendan, you can keep track of the questions, can you? You can use the chat thing to say you've got a question.
Can you see my hand up, Peter? Oh, it's gone again. I had my hand up.
Okay.
Going for you.
So you got a question?
I have. I'm Lindsay. Thank you. That was a wonderful presentation, Geoff. I'm not asleep and I'm not tired of your voice. That was really interesting. One thing you didn't touch on, and I'm very interested, and I work a lot with climate strategies and so on, is the question of EROI, energy return on energy invested, and declining EROI as we move into, say, different forms of renewables. And that's got a close economic tie. Have you got any comments to make on the trajectory we're on there?
Yeah, I mean, there's two. One of them is the EROI stuff doesn't really apply to here. The problem we've got here has nothing to do with the long-term constraints on energy in and energy out at a global level. This is entirely to do with the fact that we've got a bunch of predatory monopolists in charge of our system and a lot of neoliberal-minded officials and politicians who've set up a structure that met their ideological agenda but doesn't really help consumers. There's nothing in what I've said that is to do with the energy return on energy invested. The broader part of it is that the energy return on investment literature is really interesting. It's actually part of a 200-year debate in economics about whether technological progress can overcome diminishing returns at the margin of natural resources. And economists have been divided on this as long as there has been an economics discipline. It's now 200 years, almost exactly 200 years. It's 201 years since David Ricardo wrote a book called Principles of Political Economy. And in fact, 5 years before that, an article on profits under capitalism, in which he predicted that the capitalist economy would not be able to grow without limit because there was only so much resources, so much land in the world, and once it was fully occupied, the capitalist growth process would have to stop. And the reason why there's a debate in economics and the reason why the energy return on investment literature is problematic for us is that 200 years later, we have got tired of being slagged off by everybody else for talking about diminishing returns when global capitalism has simply roared on, crashing through every apparent obstacle that it's met. And so when the Club of Rome did the limits to growth in the 1970s, a lot of us thought, at last somebody else has come to the party. We've been losing this battle for 150 years as technology just keeps on swamping our prediction of diminishing returns. And so the Club of Rome put their flag up and they got exactly the same response that the Ricardian economists had. Guys, it's technical progress will save us. Humanity will keep on solving these problems. And while I understand all the, the entropy equations and the thermodynamic principles and so on at stake, I can't translate them satisfactorily in my own mind into the way that capitalist economies work. I do think that we have a disconnect between what the capitalist economy is going to set out to achieve and what the global resource base can sustain. I do think that there is a limit to the ability of the atmosphere to absorb our carbon waste and the ability of the biosphere to absorb our other wastes. But I don't know where that limit lies. And whether the Club of Rome's projections are correct or not, I don't know. And whether the energy return on investment calculations that I see the physicists producing are correct, I don't know either. And that is precisely because technology is an unknown quantity. We just don't know how amazingly creative capitalism may turn out to be when its back is to the wall and the knife is at its throat. I do think that in 30 years' time, the leading sector of the world economy, the biggest driver of gross domestic product, will be saving the planet. Why? Because humanity is going to want to save the planet, so at last they're going to put some money into it. Once there's money being offered to save the planet, there will be big corporates rushing forward to save the planet. They'll probably be called ExxonMobil and BP, leading the charge to absorb carbon and plant trees and do geoengineering and put mirrors in space and all that stuff. So I would, I'm very sympathetic to the energy return on investment guys, but I do think the jury is still out. 200 years of being continually demonstrated to have made the wrong prediction makes you pretty cautious looking forward. And
Can I just,
that's why economists are really reluctant to jump into this too quickly.
Can I just say something about the...
can I just say, I wasn't challenging what you've said, saying I'm really Eroi. I was meaning that's another dimension. But also the Club of Rome has been, their predictions for the business as usual curves have been pretty well validated by recent research projects in Australia and Spain. So I won't go into that now.
Yeah. I'm aware of that, but I just remind you of the peak oil debates. We had all of our peak oil projections got to 2005 and turned down. Zap, along came fracking, blown apart. And there is the problem. Until you've actually gone right along that path, including over the top and down the down path, you can't ever be sure. The jury will always be out until after the global system has collapsed.
Thank you.
Now I see Steve Goldthorpe's got his hand up. He's muted. Are you able to unmute him, Brendan?
Yeah, actually, Geoff,
Yep.
there,
Okay.
I will mention, I see we've got a couple of hands up, but there are also 4 or 5 questions on the chat. I wonder if you'd be able to click on the button and respond to a few of those. Some people have asked if we will have copies of the presentation, and we will try and make those available on the ESR website.
Yep, no problem.
And we'll also have a go at putting a recording onto YouTube as well.
Oops, I see it says we'll try to finish around 7. I've, oh dear.
That's
Sorry.
all right. So there's a few questions there on the chat. And then if there's any time left before 7:30, we might be able to take some more questions from the floor.
Okay, I've answered a couple of those already. Who owns the shares? What's the electricity percentage? Gentiles have an advantage. Yeah, what's my opinion about the price review? Well, the price review didn't answer the question it was asked, which is why have consumer prices gone up so much. They just came back and said, oh, it's all fine, there's no problem. I mean, the price review it's the third review that government has had, 1999 to 2000, 2008, 9, 10, and then 2018. In all 3 reviews, they've been stacked with insiders. They've all come back with a whitewash. None of them has been worth the taxpayer money spent in it. So, the things that they recommended are essentially just playing the competition charade more intensively, which isn't really where the big money is. Higher the carbon price, blah, 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 more profitable. Yeah, the regulator's taken that's just a comment. Could you use the electricity from Tiwai Point to do smelt? Yeah, smelt. I think you could. I mean, the usual New Zealand reaction to thinking that we've got an electricity surplus is to think of some gigantic taxpayer-funded or subsidised industry that we can put in. It's, Rob Muldoon and Bill Birch did this in the 70s and gave us nitrate fertilisers coming through our rivers and pipelines at the smelter and New Zealand steel expansion and this and that. So now the same essential lobbyists want hydrogen production at Bluff, silica smelting. It's not that they're necessarily bad projects. It's just that the knee-jerk reaction that rushes to use a surplus for some huge corporate venture, rather than thinking about ordinary households in South Auckland who actually are suffering, leaves me a bit cold, I'm afraid. I don't mind if they go and make hydrogen with the electricity at Bluff, but I want them to halve the price of electricity to South Auckland households, and or more than halve it. Would make me much happier. Can we download copies? Yes. Is there a recording? Yes. Would solar backfire on itself? Yes, it would. If you install huge amounts of solar, you won't get the return on it that you think you might get if you project without thinking about what you're doing. But is that necessarily a bad thing? No. If you have a well-being framework rather than just a pure commercial one, it's a lifestyle choice to have solar panels on your roof, and it could be worth paying for, even if you don't make a commercial buck on it. And that's my view, that the reason you put solar on your roof is so you're actually contributing to getting the global energy supply across to renewables, and that by itself deserves a reward. Yes, the feed-in tariff is rubbish. That's because the big guys in the market are trying to destroy rooftop solar at the moment. Do you think the consumer batteries would be a game changer? Yes, but there are some hidden problems with batteries that worry me, particularly the life cycle environmental impacts, until we manage to get really clean batteries. Transpower's plan to near double, yes. Will it be funded by residential consumers? Yes. Unless we get a policy change and we move back to state-owned or publicly owned, at least, or socially owned, put it more broadly, system that's run for social gain and well-being rather than for pure commercial profit. I mean, I think the big message from all this is that the dream that the market would give you better outcomes than sensible, properly organised planning run by engineers, it just turned out to be nonsense. Those are the ones on the chat that I can see. Now you've got some hands up.
Yeah, Steve had his hand up.
Yeah. Thanks, Geoff, for your explanation. I mean, there's this huge chunk of money that's being made out of electricity, and you explained that a portion of that goes to the government, and therefore the government would be reluctant to change the thing. What sort of proportion of the whole pot of surplus money goes to the government as to the investors in the industry, or in sort of investors, private investors?
Hard to say. I'm at a guess. I mean, if I was just doing a guess,
Roughly.
I haven't sat down and done that particular calculation. About a third, I would say, is the government take.
So which the ordinary consumer could say, well, the extra money I'm paying, a lot of it is tax, and if it didn't go that way, my taxes would go up. So it's a tax on electricity. But you say if 2/3 of it goes to the private and only a third to the government, then that argument is weaker.
Well, yes. I mean, it's perfectly true that as taxpayers, you get back 1/3 of the excess profits that you pay to the industry. If you think that you get a saving on your taxes from that. In fact, the way that the way that fiscal policy and the macroeconomy work, it doesn't go like that. But it's a good story. No, I mean, put it this way: if we fixed the electricity sector and really got the thing running to a social welfare goal, there would be so many other collateral effects on the economy that you would almost certainly come out ahead relative to the switch between taxpayer consumer.
Now my screen is showing Eric Jensen has put his hand up.
That's me. Can you hear me?
Yep.
Okay. Well, thank you very much for this very impressive information. I am an environmental engineer myself, working in the solar industry, so you can understand my frustration. What do you think about the low feed-in tariff of 8 cents? How much should it be in your thoughts? Because as you said, clearly we are punished as residentials. We are punished in many ways by a high price and a very low feed-in tariff. My house saves like 4,000 and more kilowatt hours a year. Should I not get carbon credits for that as well? That was my question number 2. And how come New Zealand is lacking behind for decades in very low energy efficiency? I miss the priority in New Zealand of energy efficiency in the first place. If I look to my house using only 5 to 10 kilowatt hours a day compared to the average New Zealander at 25 kilowatt hours a day, I think your story fits perfect in all that. But people like you and all the participants should start promoting more energy efficiency to overcome your story of high electricity prices as well. So I am a bit disappointed, and I wanted to have your thoughts on feed-in tariff and carbon credits for solar people like me.
Feed-in tariff is completely arbitrary. It's a political choice. It can be high or low. Remembering that if you want to go on the life cycle cost of solar, then the life cycle cost of solar at the moment is still quite high in New Zealand terms. Not as high as the household electricity price up in the high 20 cents, but it's high enough to mean that at 8 cents, for example, feed-in tariff, the life cycle payback on rooftop solar is getting squeezed quite hard. If we really wanted to have more rooftop solar, we could just jack up the feed-in tariff by a political decision. Yep, perfectly doable. Require a cross subsidy. There's lots of cross subsidies around. Could we give people carbon credits for it? Well, yes, we should. But remember that the emissions trading scheme is not designed to do that sort of thing. It doesn't have it doesn't at this stage really record even how much carbon is being saved by rooftop solar, let alone have a database of recipients of carbon credits in reward for saving emissions at the margin. The only part of the emissions trading scheme that gives credits out for doing something useful for the climate relates to forestry, where we're handing out credits like confetti to people planting pine trees. but most of the free credits are still being given out as a boondoggle to big corporates who, who want a subsidy from the rest of us. So, yeah, I mean, my answer to your two questions is, yeah, higher feed-in tariffs perfectly feasible, but it has to be a political decision. And yes, carbon credits to rooftop solar would be a good idea, but nobody's doing it yet. No, sorry, that's not right. New Zealand's policymakers are not even contemplating that yet. And if the reforms to the emissions trading scheme, sorry, go ahead.
The feed-in tariff becomes pretty much uninteresting if we have a peer-to-peer electricity market where I can sell my electricity to the dairy next door during daytime. So I wouldn't get hung up on the feed-in tariff, which, as you say, is a political decision. We've seen that in Germany. But you don't need any feed-in tariff if you can make an agreement with somebody else to buy your power.
Yeah, but these are very low conditions. I've looked in all these options. It's not really worth doing that. While other countries give 40 cents and more, Canada and other countries give much more for feed-in tariffs. So I think, New Zealand is really lagging behind compared to the rest of the world. I'm sorry for that.
I just remind you of what I was saying about the structure of the market. Your peer-to-peer stuff is out here on the right-hand end of that chart, where the distributed generators can feed directly to residential, commercial, and industrial consumers. And that is precisely where market power is going to be used and is already being used to block the development of any such market. To go peer-to-peer effectively, you've either got to have your local distribution network cooperating with you, which is how I would want them to go, or else you're going to have to build your own bypass networks. You're going to have to run your own wires to each other's houses and have your own, operator and relays and so on to share the power around. And in an ideal world, the distribution networks would be cooperating with the distributed generators to give you local pools in which people could supply electricity locally and share it around. In practice, the way we've set the market up, the distribution networks are not allowed to invest in large-scale generation themselves. There is some amount they're allowed to do, but not a lot. And the sort of deals they would have to strike to get involved with the peer-to-peer guys are unattractive relative to the commercial returns from business as usual. So it's quite a big ask to get peer-to-peer working in New Zealand. I regret to say, I mean, I'm keen on peer-to-peer stuff. I'd expected it to come years ago, but it never did.
Geoff, Molly's had her hand up for some time. I wonder if you could take a question there.
We had a question earlier about ongoing electrification.
Oh, hi, Molly.
Hi. Fancy meeting you here, Geoff.
You never know who you're going to come across, do you?
So their residential prices are due to restore. They flattened for about 4 or 5 years, and they are now due to resume their rapid upward rise by a nasty decision of the electricity price review to enable repeal of the low fixed charge regulations. This is going alongside Transpower's bold plan, which they label Te Māori Hiko, the benefit of electrification. And that plan is to near double our electricity assets, and it's going to be funded by residential consumers by requiring even the lowest residential users to pay about $2 a day. They may drop it down to $1.50 a day or something and say, oh, we're not doing all that. But the whole idea is to have fixed charges pay for the planned massive expansion of electricity assets. All the power companies need is secure revenues, and they'll get it by those repeal of those regulations. That allows them to charge much less per kilowatt hour, making solar less economic and even making energy efficiency less economic. That has been the plan of the industry, made explicit in about 2015 and agreed by the price review. So watch this space, and we must desperately lobby our parliament not to repeal the low fixed charge regulations, because by repealing that, we will see residential prices go up on a rapid upward rise in order to fund the new electricity empire. Thanks.
Agreed.
Why don't we push for abolishing fixed charges altogether and charging the network on the kilowatt hour? I mean, 99.9% of all businesses have fixed costs. We don't pay for a fixed cost for Auckland Airport's runways. We don't pay a fixed cost for the tracks of our railway system. So there's absolutely no need to pay a fixed charge in the first place. And
I agree.
the usual argument that the poor people are left over paying the bulk of the network is ridiculous, because if you install solar on your roof, you still remain connected to the grid. Otherwise, you have to oversize your solar panels by a factor of 4 or 5, so you have enough power in the winter. So the whole red herring about the poor people having to pay for the network while the rich people go off grid and have their solar panels, that's just a lie.
It is a lie. And it is because our regulator is in effect owned by the market participants. So they get to make the laws that suit their shareholders. We have got to stop that. That's pure politics. And if ESR wants to do anything about efficient energy or indeed climate change, they will damn well form a coalition to attack the Commerce Commission for setting up governance that excludes residential consumers and excludes the environment from influencing